Take this off. Hello, everyone. Welcome to Ujima Wednesdays. This month, we're studying public banking. So this series is really going to highlight the growing movement across the Commonwealth to bring a public banking to Massachusetts, which is actually Ujima's flagship issue. Yay. So I'm going to go ahead and introduce our guest speakers for the evening, Chris and Nadav, who will be chatting about sort of the origins of the mass public banking movement, as well as sort of the current bill and focus of their work. So first up, I'll introduce Christine. So Christine teaches about the international monetary system, the constitutional law of money, constitutional history, political economy, and legal theory. She's the co-founder of Harvard's program on the study of capitalism, an interdisciplinary project that brings together classes, resources, research funds aimed at exploring that topic. She's also the founder and managing editor of justmoney.org, a website that explores money as a critical side of governance. She also recently published a book, yay, called Making Money, Coin, Currency, and the Coming of Capitalism. She's also the editor of Inside Money, Retheorizing Liquidity, and co-editor with Sven Deckert of Capitalism in America. Please welcome Christine. And we also have Nadav. Welcome, Nadav. Nadav is an associate professor at the University of Colorado Law School. His scholarship and teaching focus on financial institutions, bankruptcy, community development, finance, and climate finance. Nadav's research explores the intense framework of governance and regulation that undergirds the day-to-day functioning of financial markets. So some recent projects include work on large-scale government lending programs, the past and present of central bank emergency supports, and crisis dynamics and derivatives clearinghouses. Some more work in progress includes the history of shadow banking, the liquidity premium of money, and the benefits of public banking. All, light work, super light topics. Thank you both for being here tonight. So I'll pass it to either of you to open up the discussion, and you sort of have, 30-ish minutes to sort of converse, and we'll open it up for questions at a certain point from the audience. Thank you so much.
Great. So we thought we'd do is each talk for about 10 minutes, and maybe that'll go over a little bit, but it will be well within your 30 minutes. And I'll start by telling you a little bit about the initiative for the public bank in Massachusetts, but I really want to flag the fact that this is an issue that Ujima and Nia Evans have been out in front of from the very beginning. So this was actually part of Ujima's vision, as I understand it, from Nia, and the fact that Ujima has circled back round to this initiative, I think is one of the critical things that gives it a real chance. So I think the support of Ujima and Nia's leadership on this is absolutely indispensable. So in a way, we're just kind of coming back to an issue that you all had the vision to to put on the radar a long time ago. Okay, so just a little introduction and overview of the legislation and this whole initiative. I thought I'd start just by with a list of borrowers, of the kind of borrowers who are out there in the real world, who really we would like to reach, right? Massachusetts should reach. And I'd like you to kind of think through the list of borrowers. I think you'll get right away what they have in common. So the list of borrowers: capital-starved borrowers, people without existing wealth, especially entrepreneurs of color who are shorted of that wealth given the racial wealth gap. Another kind of borrowers who are small or need technical assistance to get going, including businesses trying to get started in underserved communities where they need to build slowly, given constraints on resources. Another kind of borrowers who don't have a credit history because they haven't been able to get capital or credit in the first place. Another kind of borrowers with, say, unusual cooperative, for example, ownership structures, who therefore don't have conventional forms of collateral to offer banks. Borrowers who are sustainable and contribute to the community, but don't have significant and predictable returns in the near term. That is to say, they're not going to immediately become very, highly profitable institutions, but they're great things to support and will be very sustainable in the long run, like local restaurants, food services, land and housing trusts, small farms, businesses committed to equitable wage plans, entities trying to ameliorate climate change. Another kind of borrower that you might not think of, but has something in common with all these other borrowers, cities and towns that are home to underserved communities, particularly communities of color. I think you can see where I'm going with this, right? These are all borrowers who can't get credit under or affordable financing from commercial banks under, the current system. And the basic idea behind public banking is that communities should be able to use public money as effectively as possible for just such borrowers. Lending to that kind of borrower, all the groups that I listed, would boost economic development, would be great for social welfare, would enhance racial equity. And right now, the Commonwealth is leaving money on the table by passing up the chance to do that, right? Leaving money on the table that could go to just such borrowers. It could take back that money and lend it to that kind of borrower by claiming the capacity to lend as a bank. Or really reclaiming the capacity to lend as a bank. Public banking is a traditional strategy that states used in the 19th century, including Massachusetts, used in the past. As some of you might know, North Dakota currently has such a bank and has had a public bank for a century. There's spiking interest across the country in this strategy because it's such a great idea. So New York, California, New Jersey, just some of the places that are thinking about public banking. So just to dive then into the point, banks, commercial banks have a huge amount of power in our society. And that's not just because they have the wealth, they're holding the wealth. It's because they have the capacity to lend at a lower rate than any other lender, any other creditor. And they can lend low at a low rate because they provide the money supply in modern societies. They hold deposits, both public deposits, so our tax revenues, and private deposits, people's savings, and that ties them into a network of existing savings, existing wealth. And they create money by extending credit within that network with the support of federal and state governments. So they could only lend successfully if they're using that existing credit network, and they expand that network. And their money creative power means that banks can take a sum of capital and lend 8 to 10 times as much. So public banking at the simplest level turns on the logic that the public should have the same right as a private profit-oriented bank to take a sum of capital and lend 8 to 10 times as much. So the public should also act as a bank. It could also lend at low rates. And the current legislation, the current proposal is to do just that. So the bank that is before the Massachusetts legislature would have capital of 200 million, and that would enable the state to create at least 1.4 billion, $1.4 billion in lending. So almost $1.5 billion of lending of affordable financing for public welfare. Which brings me back to the borrowers I mentioned at the outset, because while the public would have the same power as a commercial bank, it obviously would lend in different ways to different borrowers. And that's the whole point of the public bank. Commercial banks, of course, are profit-driven institutions. They're run by investors interested in lending for relatively short-term profits. In fact, they need to to earn those profits in order to repay shareholders and other investors. And that mandate means that they leave aside a whole range of borrowers who are completely creditworthy, good borrowers who would enhance the flourishing of all of our communities. But those borrowers can't currently get financing. The public bank would lend $1.5 billion to those borrowers. So just the ones I mentioned at the outset, right? The capital poor, people who, borrowers too small, who need technical assistance, municipalities, people who don't have a credit history. You get the idea. Okay, so lots of need for this kind of institution. Just a moment on the history. And then I'll talk a bit about this current legislation. A group of activists coalesced around this idea about a decade ago, and some of those founding members are still floating around in the steering committee for the public bank, the bank effort. Chuck Grigsby was a champion of public banking, whom we lost recently to cancer. He was also a founding member from the beginning. I think it's 2015, Mel King got involved, and he recommended to the group, the group had originally been thinking about municipal banking. And he recommended that the group expand its ambition, that it would actually think not about a municipal bank, but a statewide bank. And that seems absolutely right. The first bill was filed in 2017 by Representative Byron Rushing. It proposed a bill focused on the infrastructure needs of cities and towns. And the idea here was that, there's a dramatic need by cities and towns to get funding. No commercial banks will lend to them. Cities and towns therefore go to the bond market, but the bond market has often been, the cities have to issue bonds, sell them to investors, and that's been an expensive, discriminatory way to borrow money. Often bonds come with conditions that are harmful to urban communities. As we've seen, so that was the first bill, was for an infrastructure bank that would lend to cities and town. We've seen that the need for affordable financing is much wider than that. And the COVID crisis brought that out, right? It also brought the public banking group into alliance with Ujima and with BECMA, Black Economic Council of Massachusetts. As I said, Ujima had this vision long ago. BECMA also recognized the potential of the public bank, including to lend to many small businesses in the Black community that are currently shut out due to either the racial wealth gap or long-standing patterns of discrimination. So the new legislation responds to that new expanded vision. Just a few moments about that legislation. It's very straightforward. So there's a very straightforward structure, just 1, 2, 3 in the legislation. It works like this. The kind of one section of the legislation says the state should establish a public bank and give it the same capacity as commercial banks have. You don't even have to, invent this from scratch, since commercial banks have all these capacities. The legislation literally says, we're going to give a public bank all the powers currently held by a commercial bank, right? Seems like the least we could do is empower the public in the same way that the public currently empowers commercial banks. In a later section, the bill goes back to that logic and spells out the powers, that just kind of restates the powers that commercial banks have. And those are powers to provide long-term loans at low and flexible rates, to provide unsecured loans, a variety of other things like guarantees of credit, subordinate loans, technical assistance. The legislation includes in this section a directive that when possible, the public bank should work with commercial banks. So the public bank would extend loans in partnership with existing local banks and community development finance institutions. there, the idea is that these are existing institutions. We don't want to compete with them. We want to supplement them. And we also want them on our side, right? We want to use their capacity in any way that they're willing to allow us to use it. So with banks participation loans, that is the public bank could cooperate with local banks and allow those institutions to reach more borrowers. The public bank would also cooperate with community development finance institutions, the CDFIs, and those organizations, on the ground level, at the grassroots, often know communities the best, right? And know the lending needs the most, the development needs in the community. So they are best situated to reach borrowers, often in the form of long-term flexible financing that businesses really need and other organizations need to operate. So that's the first section is, the bank basically would be empowered as commercial banks are. That's the first point. The second part of the legislation just spells out which borrowers are eligible for funding and for financing. There's, would do no good for the bank to be created and then lend to the same people who are already getting money. So we didn't want there to be any chance of that happening. The legislation, therefore, the bill spells out the kind of borrowers who are eligible. And they are the ones who have been shut out of commercially available funding so far. So the capital starved, the small businesses in need of technical assistance, cooperatives and land trusts, small farms, the CDFIs that support all those kinds of borrowers, and cities and towns. And in turn, the third kind of big project of the bill is to state the priorities for funding. So we want to be really clear here that that whoever ends up directing the bank has to follow certain priorities for the Commonwealth and respond to the needs in the Commonwealth. And here I'm just going to pick out several priorities in particular. They include borrowers from underserved communities, those subject, the way that we define that was subject to historic and current economic inequities, women borrowers, rural businesses and farms, businesses that commit to equitable wage structures, and entities that address the impacts of climate change. So basically, legislation sets up and empowers the banks, then identifies its target by specifying eligible recipients, and then identifies priorities within those recipients, right? The kind of funding we would like to see. A couple other details, the bank starts small. So the capital for this bank would be 200 million, sounds like a lot, but of course, relative to other banks, it's a very small bank. And we think of this as, a pilot project. We're hoping that this is just the beginning. Not a high risk endeavor, but something that could be an example of where we could go with this good kind of movement. And that 200 million, as I said at the beginning, would allow about $1.5 billion in new lending. Another detail to mention about the way this would all work is that the bank needs to hold deposits in order to carry out this plan. It wouldn't hold individual deposits. It would actually hold the state's existing deposits. So all of the taxes that we are all paying, all of that public revenue would go to, we would transfer. So much of that is held out of state. And there's, something like $9 billion that Massachusetts holds in big investment funds out of state. And the treasurer would be directed by the legislation to shift 1.6 billion. Again, this is starting small to the public bank. And that shift would bring back money to the state. It would leave existing deposits in Massachusetts local banks. If we can establish something like this, we would create an institution that could lend at lower rates than commercial banks, actually, because the public bank doesn't need to pay off any shareholders. We are all of its shareholders. And according to calculations that we've tried to do, it could lend at something like 2 to 5%. So pretty low, and in many cases lower than a commercial bank would be willing to lend, even if they would lend to the kind of borrowers that we want to reach. In short, the public would have the same capacity and the same privilege that commercial banks have and could lend at even lower rates, but it would lend differently. It would lend to those who are currently excluded. It would lend to those with great projects that fall outside the narrow parameters within which existing commercial banks lend. And it would lend to those who could, in many different ways, contribute to the social welfare. Just a final note here, and this is again, I think a place where Ujima is very experienced. A public bank is only as good as its governance, and the legislation is what we were trying to do as we wrote it, including sort of all the groups working together on this part of the bill, was combine expertise, which we recognize the bank needs, right? To know, it's a complicated thing to run, with popular input and accountability. So as for running the bank, there'd be a board of directors that would include the state treasurer and 8 other members who include a variety of different relevant actors like the CDFI institutions, small businesses, public finance, banks, local governments, environmentally conscious finance, and environmentally conscious lenders. The CEO would be appointed by this board and serve at the pleasure of the board, and the business plan of the CEO would be reviewed by the board. That plan would also be reviewed by a board of advisors, and the board of advisors, we hope, is the place where a community nexus occurs, and the community maintains its voice and asserts its voice where the running of the bank is concerned. So the board of advisors would collect public input and hold the board of directors accountable to that input. And advisors would come from a variety of different sectors, and they're all specified in the bill. And again, we were trying to, range widely over a number of communities that we wanted to have representation. So municipalities, food security organizations, sustainable agriculture, small businesses, particularly in underserved communities, the CDFIs, local banks, climate change organizations, and organized labor are all have, I think I've named all of them, a voice on the board of advisors. So wrapping up, I think that, and I'm hoping that the legislature sees this as a time for when creative thinking and action are extremely important. We've left communities starved for credit and for capital for decades, particularly communities of color. We've tried many things that haven't worked and come up short. The COVID crisis exacerbated the need, underscored how large the gaps are. A public bank could lend in ways that supported people with projects and energy to make all of our communities stronger and flourishing. And it could involve people. We hope it will involve people who do those projects and have that energy. So that's at least a short intro. I'll turn it over to Nadav.
All right. How can everybody hear me all right? Yeah, audio is good?
Yeah.
Okay, cool.
Yes.
Let me share my screen. Okay, and you can see the screen share, everything is good? All our tech is working?
Yep,
Okay,
all good, Nadav.
great. Yes, a huge shout out again to Ujima and to Beckma and to everybody at the public banking crew and the CDFIs. I see Gerardo is here. I wanted to follow up by talking about a question that we get often and that I think is a very important question that is worth discussing. And that question is, if the Public Bank of Massachusetts, which I hear, completely without authority, dubbed as PEBMA, right? You need an acronym for a bank and a public institution. It's very important. So I don't know if it will be called PEBMA, but let's just call it that for now. So if PEBMA lending is safe, why aren't private banks doing that? Okay, it's a question we've received time and time and time again, and you can hear some thoughts about that are folded into Chris's talk. So let's try to put this front and center for the next 10 minutes. Okay, so what does this question assume? It creates a kind of paradox where either the lending is safe, right? And in which case, the point is that the public bank is redundant, right? If the lending is safe, let private banks do it. We don't need a public bank. Or the other leg of this is if the lending is unsafe, in which, of course, we don't want a public bank to take undue risk. Okay, so this creates a kind of lose-lose situation where you can never justify the existence of a public bank. Okay, very, 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 very common priors with which folks come into this debate. Okay, so I want to present part of the answer that Chris referenced. The point is that public banks enjoy meaningful cost savings. And these cost savings will be channeled into their public mission. Right? On the other hand, private banks that have higher costs simply cannot afford this type of public mission lending. It's part of the answer. It's not the entire answer. And of course, it's not a historicized answer, and it's an answer that abstracts from a lot of the inequities that we talked about. But it is an important piece of the answer. Okay, so let's unpack this. So part one in unpacking this is understanding what kind of a thing is a bank. Okay, a bank is a very particular type of a machine. This is going to be fast, and this is just a tasting menu, so we can talk about all these things for hours and days and weeks and months. And in fact, I think it would be a good idea for us to talk about these things in great depth because this is the nuts and bolts of the project. Okay, so I think empowerment means that we come to understand them better, that we gain a sense of mastery over them. So here's a bank, and on the left-hand side, you can see the assets. Okay, so these, for a bank, these would typically be loans. Okay, virtually all, this is a somewhat simplified diagram, but virtually all of the assets of a private bank or the public bank for that matter are going to be long-term loans that generate interest. On the liability side, a bank is funded primarily through deposit liabilities. Okay, so when Chris talks about banks create the money supply, right? That's what we're talking about. We're talking about the fact that almost the entire funding, so here, $90 out of $100 comes from deposit liabilities. Okay, what do these deposit liabilities cost banks? Well, not very much, right? Just think about how much you're getting on your bank deposit. I get 0%. Okay, and then there's the third piece, which is really important, and that is equity. Okay, so equity is formally defined as assets minus liabilities. Okay, and this represents the capital that shareholders have in a bank. So equity and capital are generally synonyms when we talk about banks. Okay, so now this is the basic machine that we're talking about, whether it's a private bank or a public bank. Now, what are the constraints that apply to this machine? So this machine is getting income as an input. Okay, where's this income coming from? It's mainly coming from interest that is generated on the loans on the asset side. Okay, this green stuff that generates income. There's also a little bit of non-interest income, but interest income is by far the largest portion of bank earnings. Okay, and this machine needs power to run, right? So they're expenses. What are the expenses? So operating costs are by far the largest expenses of a bank. So this is brick and mortar, okay? So having branches, this is having staff, this is having customer service representatives, this is having sophisticated information technology systems, this is having sophisticated regulatory compliance, this is having marketing, okay? These are operating costs. There's a small interest expense, right? So some depositors get a little bit of interest. And there's something called an allowance for credit losses. So the basic idea here is you make $100 of loans. Well, not everybody is going to pay you 100% of the loan and interest, right? Some people are going to default. Sometimes you're not going to recover all of it. You're not going to recover all of it. So you need to make a deduction for that. Okay, so we have income and we have expenses. Then the third piece is net income. So net income is income minus expenses. Okay, we're getting technical here. Income minus expenses, that's net income. Okay, and what do you do with that net income? Well, you have to pay it to shareholders, right? So now we're talking about the constraint that applies to a private bank in a for-profit business model. So there's equity of 10% that is invested in this bank, right? These shareholders want a return. The typical return that they want ranges at around 10%, okay? So if we said $100 of assets, you need for $100 of assets, you need equity of $10, right? So that's about the 1 to 10 proportion that Chris mentioned. Well, 10% of that 10%, right? $1 has to go as profits to shareholders under a for-profit model, okay? So that is the basic constraint, and I'm writing it down here. Income minus expenses, right? Which is basically this net income concept. At the end of the day, in a for-profit system, it has to amount to about 1% of assets. Otherwise, you cannot run a for-profit bank in the long run. You know, it could fluctuate for a quarter, it could fluctuate for a year. This is the long trajectory. Okay, so now I want to show you very quickly, very quickly, because we want to save time for discussion. I want to show you very quickly some of the modeling that we've been doing that tries to show how the public bank is different when it comes to this equation. So you can see Massachusetts banks here. So that stands for private commercial banks that are operating in Massachusetts. And you can see the Public Bank of Massachusetts, and these are projections, right? We don't have actual numbers. So the first thing I'd like to draw your attention to is this expenses box, okay, with the red title. And what it shows is that while private Massachusetts banks have expenses that are 3.4% of assets annually, okay, 3.4%, the projections for a public bank are that expenses are only going to be 0.84. Okay, so it's about a 2.5% difference. Now, remember, 2.5% doesn't sound much, but 1% of assets is the entire profit that goes to private shareholders, okay, annually. So 2.5% is a huge amount, okay? We need to really sensitize ourselves to these very seemingly small figures. Okay, 3.4 versus under 1%. Where are these savings coming from? Okay, and you can see here in the non-interest expense row that about 2% of this is coming from non-interest expenses. Why is that happening? That is happening for two different reasons. The first reason is that on the asset side, okay, on the asset side, the public bank is going to use intermediaries, right? The community development financial institutions and the community banks, et cetera, right? That means that you don't need a lot of staff, you don't need a lot of branches, you don't need a lot of infrastructure for that. So that is a major cost saving. And even larger cost saving is the fact that on the liability side, there is virtually only one depositor, and that is the treasurer, the Office of the Treasurer of Massachusetts. Okay, so this huge amount of operating costs, staff, customer service, IT system, branches, ATMs, all of that stuff that a private bank, all of that investment that a private bank will need to make, a public bank saves. Even on equity, and this is not immediately reflected in the spreadsheet that you wrote, the return, that's something that Chris mentioned, the return could be lower. So we don't necessarily need 10%, maybe we need something like 5%, right? To allow the bank to grow, to allow it to build its risk reserves, et cetera. Okay, so let's go back to the spreadsheet. So what you can see is that we're getting about a 2.5% cost saving from having a public bank. What are we doing? What are we doing with these savings? Okay, and I'd like to draw your attention to two different parts in the spreadsheet. Okay, 2.5 to 3%. One is income. Okay, and you can see that the income that the public bank would get is here modeled to be lower, right? 2.5% versus 4.5% than the income of a private bank. Why is that? Right? Why do we want lower income? Because lower income means lower rates to borrowers, right? It means that we could take these savings, these cost savings that we're generating, and we can channel them to lower lending rates to the customers of the public bank, the CDFIs, and ultimately the communities, the underserved communities that it will serve. That is a game changer. Okay, we've done a survey among CDFIs. None of the CDFIs that we've surveyed was interested, for example, in loans that were above 3%. Okay, so if we can get 2.5 or 3% loans, that means that there's take up from CDFIs. But at 4%, right, which is the rate that bank offers, which they have to, in a sense, if they operate under the constraints of for-profit institutions, there's no take up. Okay, so that is number one. Number two is allowance for credit losses. Okay, so the allowance for credit losses for a private bank is virtually nothing here. This is 2019 data. Okay, 0.06%. We have budgeted more than 1% in loss reserves, which is a lot. Okay, that is a very substantial loan loss reserves. And this is also meant to make the bank more prudent in terms of risk management. Okay, so let's discuss these ideas and stay in touch. We can always, this is very fast moving presentation, but we can always discuss these ideas in greater detail. Just the takeaway that I'd like to leave us with is, remember that think of a bank as a kind of a machine, okay? It has a basic balance sheet structure, it has income, it has expenses. We're trying to build something that uses these constraints, but tweaks them in a different way that, like Chris said, allows for a different kind of lending. I think that's at the end of the day, the nature of the exercise. And what we're using here, the biggest franchise that we're using is the capacity of the Commonwealth to act as a bank depositor.
Thank you so much, both Nadav and Chris. To answer Lisa's question, yes, this video will be on YouTube. I believe next Wednesday we'll post it, so you'll be able to see the notes and the video recording for folks who have to pop off. In the last couple of minutes, do folks have any questions for either Chris or Nadav? You're welcome to put it in the chat or come off mute and ask yourself if you'd like.
I would love to ask a question myself, right? If people in the, who are listening are willing to talk about this. And one of the things that we need to build is a sense of the kind of borrowing that people want to do. So I would love to know if anybody in the audience, in the group, knows of borrowers who have a project that would be sustainable, and they just need credit to get going, right? So, if you or someone has such a project, it would be great just to hear you state it, because that gives us the kind of ideas that we need to tell the legislature about. We might draft you to tell the legislature about it, but just, that this kind of feedback is really what will make this bank work.
I see Rebecca has her hand up, and I see Joel Mackel also has a question in the chat.
Okay. If you want to answer the questions in the chat first, that's fine. Like, I work for a CDFI, and so we work.
You're muted, Rebecca.
Rebecca.
Okay, I'm sorry. If you'd like to answer the question first, that's fine. I work for a CDFI, so that I could ramble on about that. So, yeah.
So the question strikes me as the key question, right? I mean, I think that the resistance of the banking industry is the single most critical resistance that we face, all of us, in trying to get this idea across. And I think that they, ideally, they would understand that this could be complementary to the work they're doing, right? Ideally, they would get the idea. Gerardo, who's on the call, likes to say, CDFIs like to lose customers, right? Build up a business, a small business, and make it big enough. He has a great example of Gerardo, you might remind me the name of the place. The guy starts with one food truck, right? And then he builds up to 2 food trucks. And then, ultimately he can get a little restaurant and be, or maybe a whole fleet of food trucks, and be the kind of borrower that a bank will attend to. So ideally the banks would see that. I think, deep down, they might just find it's good to have a monopoly. Right? It's good to have a monopoly. And so some bankers who aren't that generous in their thinking might just feel threatened, because this is a crack in their monopoly, and they won't understand that it's complementary. And there, I think, so to get to what I think is the best defenses, a couple. One is just trying to explain to them again and again that this could actually help them, both in the near term, they get the food truck borrower. In the longer term, it's good for them too if the community flourishes, right? If we build a stronger communities, that's good for banks. And number 3, I think the kind of work that Nadav had on the board, showing the facts and figures, doing our homework, which we are trying to do, and we could use all of your help on, to build the case so that we can just say, look, here's the facts and figures. Here's what a public bank could do that a commercial bank can't do. Here's the kind of need that still exists that the commercial banks can't get to. I think all of those things are going to matter in responding to the commercial banks. Nadav, you have?
Yeah, I completely agree. And I think that it's really important to appreciate the kind of constraints that a private bank is working under, so that we can articulate an alternative model. I think the more specificity in the way we do it, the better. Completely agree with Chris. I think storytelling, and I think stories that inspire us about the kind of economic development that we would all hope to see. I think that that's a huge aspect of it, and learned a huge deal, for example, from Gerardo and from other CDFI folks And lastly, I think there's a sense of urgency, which, of course, in Ujima, it's been going on for a while, but there's a sense of urgency now for racial justice initiative, and I think that is also something that is felt within the financial sector, and I think that is a potential bridge that yeah, we should try to find as much common denominators as we can.
I think I see Gerardo. Are you waving your hand? Gerardo from Leaf, by the way.
Yeah, no, I'm waving my hand. Thank you, Christine and Nada, for the great presentation. I just wanted to add one point, I guess, to the list of elements that you have been mentioning in terms of how this complements the bank. My sense is, in addition to the points you mentioned, there are structures for which, and I think Christine mentioned this when she was talking, a structure for which the banks are not suited for. They just don't see enough of this type of transactions, or for regulatory reasons, they cannot handle this type of transactions because they either need collateral or need the guarantees and so on. And I think a great illustration of this is all this work with, for instance, what we call manufactured homes. Manufactured homes, for persons that are not familiar with these, are homes that are mobile. In the past, they used to be called, I don't know what was the derogatory name for this, but these are homes that are built now to code. And so the owner owns the home, but they don't own the land. Right? And as soon as you have a situation like that, where the owner, the home is not linked to the land, the banks don't know what to do, right? And just to give a sense of the impact of this, there are about 14 million people in the US that live in manufactured homes. And those homes those folks tend to be not low income, but very low income. Right? And so for instance, a structure like cooperatives allow the owners of those homes to buy the land as a cooperative, right? So by owning the land, they avoid the fear of being displaced from their homes, because that land could be sold by the investor anytime. And a park of 300 homes may need to move in a period of a couple of months, and moving those homes is expensive. So these folks are normally in fear of this, and they are also in fear of rent increases. And a cooperative is a model that takes care of that problem. I think the innovator on this was New Hampshire Community Loan Fund at CDFI. By this time, I believe they have converted about 120 parks, communities, 120 communities. They only had a problem loan with one of them, not a write-off, but a problem loan with one of them. Was an excellent model. And now that model is even being supported or funded by entities like Bank of America. But that would never have gotten out of, and here we're not talking about something that has minimum impact. Again, we're talking about something that could affect the lives of 12 or 14 million very low income people. And the banking system sometimes doesn't have sometimes we refer to that as the plumbing to channel the finance to those type of borrowers, right? And these intermediaries are the ones that open the way. So to me, these are great illustrations of the contributions they make in all sorts of areas of need for the community.
Great.
Thank you for the time. Thank you.
Thank you so much, Gerardo. That was wonderful. And thank you again to Nadav and Chris. Folks, we do need to sort of wrap this up at this point. This was really rich and insightful. So thank you all for joining. At this point, we'll go ahead and say goodbye to people watching on YouTube. So I can go ahead and just end the recording here, and we'll sort of start to transition at this point.